All right, it looks like we've got a bunch of folks that have joined, so let's get things started. Good morning. Welcome to Opportunities in Overseas Markets. My name is Glen Goland. I'm a Senior Investment Advisor here at Arnerich Massena. And thank you so very much for joining us today. We're excited to welcome you to this conversation with two of our research analysts and with two of the portfolio managers whose international funds are in many of our client portfolios. To our clients who are on the line with us today, thank you so very much for the faith that you've placed in our team. We appreciate it and we look forward to continuing to earn your trust going forward. We're very, very proud to bring you some of our very best ideas today. So Bob Dylan once wrote, "The slow ones now will later be fast, and the first ones now will later be last, for the times they are a-changing." And as we look at everything that's happened over the last few years, one of the biggest questions we're getting in our client meetings is whether we are seeing a change in market leadership. It's one of the primary reasons we scheduled this call. We think that everyone on the call today will come away with some valuable information and some perspective on the risks and opportunities presented by the international markets, and we're pleased to provide a forum to share some of these ideas. So it is my great pleasure to be hosting the webinar today along with two of my all-time favorite colleagues, Ben and Melissa, as well as two of our special guest panelists. Each of our guests today brings a wealth of knowledge, and I am just about ready to stop talking and let them start. So Ben and Melissa are both research analysts on our team. They will be taking a look at our outlook and some of our current positioning as it relates to international markets. They'll share some data about the current environment and provide some historical comparisons to give us a big picture overview. Next, Rama Krishna is the founder and chief investment officer at Arga Investment Management. He will be focusing his comments primarily on the emerging markets, an area that our clients and all of us have been paying a lot of attention to this year as we've watched the terrible humanitarian cost of Russia's invasion of Ukraine. And then finally, we'll close with Christopher Lees. Chris is Senior Portfolio Manager for the JO Hambro Global Select and the International Select Equity Strategies. We have been investing with Chris's team for over 13 years. So his fund, is a cornerstone in a lot of our client portfolios. So Chris is going to share his thoughts on what he's seeing in the international markets, particularly in those developed economies. So with that, I will hand things over to Ben and Melissa, and we can get started on your side of things, guys. The floor is yours.
Great. Thanks, Glenn. You go to the next slide. Great. So to start, I wanted to provide just a quick refresher on what countries are considered a part of the developed markets, EM, emerging markets, EM, and frontier markets, FM. So just to highlight a few, developed markets include the United States, Canada, and the United Kingdom. And then Brazil, China, and India are a few countries in the emerging markets. Notably, Russia was recently moved from the EM index and to the MSCI standalone market index below, as you can see. And then Vietnam, Nigeria, and Pakistan are some countries of note within the frontier markets. Next slide. Now, while the US is only one name on that list, when it comes to the MSCI All Country World Index, the ACWI, the United States now makes up more than 61%, an all-time high. And so to put that into some perspective, that's about 4,000 publicly traded stocks in the United States versus 37,000 publicly traded stocks internationally. So what's driven this pretty dramatic increase in the US markets? Next slide. Performance is one. So this is a chart from JP Morgan. We're looking at alternating cycles of outperformance between the MSCI Europe, Australasia, Far East Index, also known as the EFI, in purple, and then the MSCI USA, which is in gray. So today's cycle is on the very far right. First, you can see how today's cycle of the US outperformance has lasted longer than any other cycle in history. So we're currently at 14 and a half years compared to the next longest cycle of just a little over 7 years. And then we can also see the historical extent of this outperformance. So it's second only to this EFI cycle in the late 80s, early 90s, which was driven by Japan's rapid bull market. Clearly, it's just a dominating period of US performance across the board. Next slide.
And to touch on a little bit about what's happened over the last 10 years, we wanted to provide a little bit of insight into the attribution over the last 10 years from different indices and different regions of the market. So if we look at the top bar, you can see that shows total return numbers annualized from 2012 to 2021 over the last 10 years for each respective index. And so down below, you can see S&P 500 is on the left. That's a proxy for the US markets. EFI small and large is a proxy for developed markets. EM, large and small, are emerging markets. And then you have Europe and Japan on the right. And so if we break it down by each individual legend color, you can see that there's fundamentals. So within the darker blue, that shows margin expansion. So really how profitable is a company, or how profitable a company is. The pink shows sales growth, which how quickly a company is growing. Darker green shows dividend return, and then the lighter green returns FX or currency movement. And those are all fundamentals. And then you have gold, which shows multiple expansion, meaning how much are people willing to pay? So if you're an investor, you're willing to pay more for a company, multiples expand. And if you're willing to pay less, barring that fundamentals don't change, multiples contract. And so if we focus on the left-hand side, you can see that the S&P 500, which the total return was 16.7%. And within that, you can see that 6% was contributed from purely margin expansion. So people were willing to pay more for the US stocks. And if we look, everything to the right of that is international. And you can see that fundamentals, so sales growth, margin expansion, and dividend yields in international markets have either been comparable or better than those in the US markets. And so if we look and turn to the next slide, let's highlight two specific cases. And these are more extreme cases, but I think this tells the story of US and international markets and what's happened over the last 10 years. And so again, we're highlighting the S&P, which is the US, and then EFA small, which is a proxy for developed small market. And you can see the total returns at the top. So the US market over the last 10 years returned 16.7%, and EFA small returned 8.9%. So almost half of what the US markets returned. But if you look at the fundamentals, you can see a significant difference. EFA small had 16.2% margin expansion, whereas that's of 3.9%. So almost a 4x on margin expansion for EFA small, along with sales growth slightly less, and then dividend return was greater for the EFA small index. But it underperformed, right? And so if you look, the reason for the underperformance was a little bit of currency. So the US dollar was strong over the last 10 years, but then also multiple expansion. So less fundamentals driving that, but more of how much are people willing to pay. And so the question is, can this last in perpetuity? Do people and investors, do they want to just keep paying for US stocks, or will fundamentals and earnings ultimately win out? So if we flip to the next slide. So one thing that we think of within this context is valuations. And valuations are a pretty good predictor of future long-term returns. And so just an anecdote, we believe over the past 10 years, monetary policy from the Fed and other central banks have created an environment that's been conducive and favored more high multiple, high growth equities relative to valuation sensitive equities, given that interest rates are so almost negative, but on a real term, but close to zero. And recent monetary policy points to a tightening cycle that will, we believe, require many years to unwind. And in our view, kind of threatening that leadership of high multiple areas of the market. And as we all saw yesterday, the Fed hiked 75 basis points and indicated that over the next coming months, they plan to, given that economic data, obviously be reliant on that, but plan to continue to hike interest rates. And so when we look at this chart specifically, which is showing international versus the US, specifically within price to earnings ratio in that line chart, we can see that over the last 20 years, international markets traded roughly about a 20% discount to US markets. So in other words, US stocks have historically traded at a premium to international stocks. And today, indicated by that red font, we can see that we currently sit at 2 standard deviations below that historical average, with international names trading roughly 35% discount relative to the US. And so if we turn that and we take that in tandem, turn to the top of the page, and we look at that table up there, the dividend yield is 3% for international stocks versus 1.5% for the S&P 500. So almost a 2x dividend yield. So, in summary, international stocks are trading on cheaper valuations, generally speaking, with more attractive fundamental characteristics. So if we turn to the next slide, I'll pass it back over to Melissa.
I think finally, we're going to talk about active management and its role in international markets. We'd be remiss not to mention that, given we have two great active managers that we have approved with us today. So charted here, we have the average annual frequency of active management outperformance. So on the horizontal axis, as we move out right, active managers tend to outperform more often. And then on the vertical axis, we have the magnitude of outperformance. So the average alpha these active managers produce. We can see that not only do active managers in international spaces outperform more often than the active managers in the United States, they also tend to beat the benchmark by a greater amount. And I think this does a really good job of underscoring why we at Arnerich emphasize active management in the non-US asset classes, especially with our two managers here today. So with that, Glenn, I'm passing it back to you.
Well, thank you very much, Ben and Melissa. As you alluded to, Melissa, the data presented thus far is largely centered on broad market indices. And so our firm prides itself on looking all over the world for men and women that can actively trade in these markets. And so we're thrilled to have a handful, or a couple rather, of those managers with us today. The first of these groups is led by Rama Krishna at Arga, a manager we've known for over a decade and which was added to our approved list last year. Rama, thank you so very much for being here today. The floor is yours. It looks like you're muted, so if you could unmute your line, we'd love to hear from you.
Thank you. Thanks. So I want to spend a few minutes talking broadly about the environment we're in today and then set the context for emerging markets within that. So Oscar Wilde used to say that he liked men with a future and women with a past. Now, we wouldn't all agree with that, but we certainly would agree that a lot of the emerging market countries today have a future and have a lot of history that actually can be very illuminating as to how they might behave in the future as well. So with that, if you look at the world today, and you think about the three major issues affecting markets in general, the first is that we have excessive debt levels in most developed markets with extremely low interest rates relative to the level of inflation. And this has been going on for almost 8 or 9 years in most parts of developed markets, but accentuated in the last few months, as we've seen from the inflation data. The second part of the world that we are worried about is the fact that today you have a lot of inequality. And that's, again, if you look at the numbers today, the highest it's pretty much ever been since World War I. And what happens with inequality is that it leads to polarization in terms of politics and behavior within countries. And eventually that leads us to the third issue. It leads to polarization between countries as well. And you're seeing that happen today. If you look at the US today, I think the difference in views between the two parties is extreme as it's ever been. And equally important, to look at geopolitics in the world today, you will again see that literally countries have gone to war today. I mean, clearly the war that we read about every day is the Russian invasion of Ukraine, and how Ukraine is clearly doing its best to offset that as much as possible. But there are actually a lot of wars being fought today. And wars to us are not just military wars. They tend to be economic wars, trade wars, capital wars, and we can certainly discuss those in greater detail in Q&A. But our point is, in today's world, you have a lot of angst, both from a financial market standpoint and from a geopolitical standpoint, intra-country and inter-country as well. In that context, our view is that emerging markets offer opportunities today that perhaps are better than they've ever been in history. we'll come to the major portion of that, which is what we at Arga focus on, valuation. But before that, I want to give a few key characteristics of emerging markets that set themselves apart in the context of the three major issues that you're worried about in the world today. The first, of course, is high debt levels in most of the developed world, and equally importantly, the fact that you got interest rates and inflation that perhaps are going to stay high or move higher in most of the developed world. What's interesting is that in most emerging markets, you already saw a tightening cycle last year. When you saw the US dollar strong, these countries were importing inflation, they decided that they would go ahead and hike rates. So a number of emerging markets, with the exceptions of perhaps Turkey and China, did actually see interest rates increase in the last year. So they're in a better position to deal with monetary easing at a point when their economies perhaps weaken, with slower growth rates across the world. Equally importantly, if you look at the largest emerging market of them all, which is China, interestingly, it did not have any kind of monetary or fiscal stimulus of any significance relative to the GDP growth rates. If you look at the stimulus in China for the last 5-6 years, it's been minimal to the nominal GDP growth rates you've seen, close to about 10% or so. In that context, again, we would argue that China, given its overall fiscal position, as well as the ability to actually cut rates. In fact, if you look at the G4 bond markets today, China presents the highest nominal and real yields pretty much till, I guess, the very recent couple of weeks. And so in that context, again, our view is China is extremely well positioned to provide good fiscal stimulus, and as well as strong monetary stimulus if it needs to at some point in time in the near future. And that applies not just to China, but a number of other emerging markets. Now, clearly, Russia is out of the question here from an investability standpoint, so I'm not going to talk much about that. But if you look at India, for example, they manage their fiscal finances pretty well, completely reformed the tax system there as well. And yes, India has its issues, but at the same time, though, is in a very good position, both from a fiscal and a monetary standpoint, than pretty much it's been in the last 3-4 decades. So to that extent, again, India is very well positioned in the context. Brazil is, again, one of the countries you read about in the headlines because of all the political changes that are likely to happen over the next year, depending on how the elections fare out. But there again, we would argue that valuations are very attractive because of those fears, and interest rates are high again because of fears, and in a good position as things stabilize to actually bring about a better environment from a financial market standpoint. And those would be some of the bigger emerging markets today. And of course, Korea and Taiwan, much more controlled, both in terms of inflation as well as their fiscal situations. So there again, we see countries that set an example, perhaps, in terms of how they manage the overall fiscal situation. So in terms of the first concern that we had, we actually believe that emerging markets, from a fiscal standpoint, are far better positioned to deal with the upcoming few years in terms of where the stresses are going to be in the world. The second point, which is about inequalities and perhaps polarization intra-country, what you have in emerging markets is clearly a lot of these countries not exactly democracies the way we would see them. Some countries call themselves democracies, but they tend to be a lot more unified in terms of an approach, at least, to inequalities. And when that gets out of bound, like it did in China, there is a strong focus on bringing about convergence one way or the other in ways perhaps we wouldn't be able to contemplate in much of the Western world. And there again, our view is the fact that they're focused on it leads to perhaps better income distribution over time in some of these countries. Not all, India has a share of inequalities and so do some of the other markets. But particularly in some of the larger markets such as China, Korea, and Taiwan, we would see inequality being less of an issue over time. And whenever those issues do crop up, there are actions taken to deal with them far more aggressively than we would be able to do in the Western world. And that leads to more stable economies over time. And lastly, from the standpoint of geopolitics, one of the big lessons you have learned, at least we have learned over the last 100 years of looking at geopolitics, is that countries that stay neutral in a war typically tend to prosper coming out of bad geopolitical situations. And what you find today is a lot of the emerging markets are relatively neutral. Yes, China perhaps, clearly from the rhetoric, seem to be biased towards Russia, but they're clearly not supporting Russia militarily, at least from what we can glean from the information that's publicly available. India seeking to be very neutral as well. Brazil, very neutral as well. So when we look at these countries from a geopolitical standpoint, we see them coming through this as well as any country can, a period of stress from a geopolitical standpoint, and actually in the long run, perhaps benefiting from the stress as well. And there's several examples which you can look at from that standpoint. For example, take the US dollar as a reserve currency in the world today. Countries have always relied on the US as being a very stable part of the world from a geopolitical standpoint because of the fact that we have a rule of law here. Equally importantly, because they felt the foreign exchange reserves were being very safe, you would hold them in the US dollar as the world's reserve currency. But as you saw with the sanctions in Russia, you can't take that assumption as being sacrosanct. Those Russian reserves today clearly are at risk. And that's led to a wake-up call where almost every country in the world is saying we need to diversify our reserves away from the US dollar. Saudi Arabia, for example, potentially could have almost all of its oil exports priced in terms of renminbi, as opposed to dealing with the US dollar when it comes to selling oil to China. And China is roughly accounts for 20% of Saudi Arabia's exports. So from that standpoint, we believe that the US dollar reserve currency is going to go down over time. It's not going to happen overnight. That's part of the reason why it's a reserve currency. But there's clearly a move away from the US dollar where countries can actually do it. And the sanctions have accelerated that pace, as we can at least see from the information that we've been able to glean. Equally importantly, we would argue that in today's world, if you look at most parts of emerging markets, such as China, for example, they are doing whatever it takes to build relationships with other countries outside of the US and other developed market orbit. So China, for example, has made big inroads into Africa in the last few decades, mostly for their own reasons from a resourcing standpoint, literally going after commodities in a big way, not just energy, but copper, other precious metals, or for that matter, some of the electric vehicle related metals for batteries. Equally importantly, they're making big inroads into countries that were traditionally US allies, such as the UAE and Saudi Arabia. They're investing huge amounts, collaborating them, not only economically, which Saudi Arabia and the UAE want. They want foreign direct investment for manufacturing, for example, in their economies. China is at the forefront of doing that, but equally importantly from a military standpoint as well. So you're seeing in today's world, countries like China being able to make those inroads into some of these countries. And we would argue that other countries, such as India, for example, or Brazil as well, given the neutrality in today's global geopolitical situation, are very well positioned to take advantage of opportunities wherever they might exist, the companies there, as opposed to aligning themselves with one part of the world or the other. And history has always shown that seems to be a winning strategy. It certainly worked for Switzerland, going back to the 2 world wars. And we expect that these countries should benefit this time around as well. So broadly, our view is that emerging markets are perhaps, given the number of countries you have in emerging markets and the diversity you can bring in terms of your exposures at the company level to those markets, present to us a very compelling opportunity to be there. Now, from the standpoint of the importance of emerging markets, we believe that emerging markets typically have a significantly lower weighting than where they could perhaps end up in the long run. If you think about emerging markets today, the weight in the world is less than 15%, actually about 12% in the MSCI All Country World Index. So it's very rare to see investors that even have that 12% allocation within the equity pool to emerging markets. Typical allocations perhaps are somewhere in the 6% range from what we can tell. So the 12% weighting would actually be considered to be a significant overweight for most allocations in the world today. On the other hand, when you look at where emerging markets are today, our view is the share of real GDP for emerging markets is going to significantly increase over time. If you look at where they are at a percentage of foreign exchange reserves today, emerging markets account for roughly 60%. The emerging market countries have 60% of all global foreign exchange reserves today. They account for 60% of global GDP. And if you think about the number of companies from emerging markets, for example, in MSCI All Country World, that's almost 47% of the number of companies. And that accounts only, as we talked about earlier, close to about 12% of market cap. So we look at this and say, just mathematically, these numbers in terms of allocations should go substantially higher from the 6% allocations you have today. And the US has been a significant beneficiary of inflows over the last few years, partly because liquidity conditions in the US were dramatic. If you think about the stimulus that you had post-pandemic and the growth in M1 money, M2 money supply, for example, that was 40%. Those numbers are significantly lower in emerging markets. And our view is, as liquidity conditions tighten in the United States, like they appear to be finally, you should see a move away from some of the developed markets to emerging markets over time. And you actually have, in our view, some signs of that happening in the past, whenever you saw these kind of tightenings. And you go back even to the early 90s, one of the reasons why emerging markets did really well in the early 90s was the implosions of Japanese equity markets as interest rates rose there. And if you go back in history and look at it, you'll typically see whenever liquidity is constrained in developed markets, emerging markets tend to do really well. And you saw that even after the collapse of the TMT bubble at the end of the 90s. The period from 2013 onwards tended to be a spectacular period for emerging market equities in terms of performance versus US equities. With that, I want to move on to the most important aspect of what we see in emerging markets today, and that is the valuation opportunities. So if you go to the first slide, actually, this shows you the relative returns of the US market versus other markets. You'll see that the US market in the last decade, almost 2.5 times the outperformance of other markets across the world. Go on to the next page. And this is the key point. What we have here is the cyclically adjusted PE ratio of the US market versus emerging markets. And you'll see that the spread there is amongst the widest it's been in history. And our view is it's never been that wide. And equally importantly, there have been periods where emerging markets were more expensive than the US market. And we're perhaps at a time now where that's likely to happen again as we go forward from here. If we turn to the next slide. Our view with the US market is that long-term real returns, this is just by simply looking at the PE current prices versus trend growth in earnings. And that seems to be a good indicator of long-term returns, the inverse of that. And what it tells you is that long-term real returns in the US are going to be about 2%. And if we turn to the next slide, you'll see that the returns for value are around the 2% level. On the other hand, if you go to the next slide, you'll see the returns for US value about 1%. So not a huge difference in spreads between value and growth in US market. In the case of non-US equity markets, just very quickly running through that using the same analysis, and looking at EFA, we turn to the next slide. you'll see that EFA has roughly long-term real returns in excess of 4%. And moving on to the next slide for EFA value, we see that being roughly around that number, 4% or so. And then turning to growth, again, on the next slide, slightly below 4%. So again, EFA, not a lot of differentiation between value and growth. But then let's look at emerging markets on the next slide. Long-term real returns for us in emerging markets are closer to the 12% range. And then if we turn to the next slide, you'll see that long-term real returns for value in emerging markets are closer to 15%. And growth, flipping to the next slide, is about 8%. So our view is within equities, emerging markets, and particularly emerging markets value are the most attractive asset classes today, in our belief. So if we turn to the next slide, and this is the reason why we believe valuations eventually work. What we have here is the performance of the cheapest quintile of price to book over time. This is for all global stocks versus the performance of the most expensive quintiles of valuation. So if you think about the cheapest quintile of valuation, and we'll come to that in a few minutes, it's got a preponderance of emerging market stocks today and very little in terms of US stocks. On the other hand, the most expensive quintiles of valuation have a preponderance of US stocks, and it's been the case for much of the last decade. And what's interesting, though, is that if you own the cheapest quintile of valuation, and we used roughly 47 years worth of data here, annualized, you get roughly a 5% upgrading of valuations annually. On the other hand, if you own the two most expensive quintiles of valuation, I can see here, the declines in those most expensive quintiles of valuation even greater than the increase in the valuations of the cheapest quintile. And this is mean reversion at work. And you can see it happening real time today in the United States. See what has happened to some of these high flyers in the technology space. The excess has been there. In our views, some of that is being taken out. Now, again, we don't make market calls, but we don't find a lot of attractiveness in the most expensive quintiles of valuation today. And a lot of them still dominated by technology names. On the other hand, we find emerging markets within the cheapest quintile as accounting of the biggest proportion of all geographical areas. And in our view, this is where the returns are likely to come from. If you turn to page 14, the slide 14, you'll see the same thing with earnings mean reversion. And what's interesting is valuation eventually works not just because of valuations mean reversion, but also works because earnings mean revert. If you own the cheapest quintile of stocks, what you find for them is earnings for those companies actually grow by 12% over the subsequent 5 years. If you own the most expensive quintile of stocks, interestingly, the earnings actually go down by 7%. This is extremely powerful tendency, and this is why valuation works in the long run. It's because of mean reversion factors, not just in terms of earnings, in terms of valuation, but also in terms of earnings. What's interesting for us is that geographically, the US market has been till right now at its highest point of profitability pretty much in history. On the other hand, look at emerging markets, they're at the average rate. They used to be at a low about a year and a half ago, and despite not much growth, they've actually improved the profitability, whereas the US, in our view, is going to be going down in terms of the margins and profitability over time. And that's why, again, why we feel so strongly about emerging markets. And turning to the next slide. So just shows you where the opportunities are in terms of spreads. This is a spread between the cheapest and most expensive names, the top quintile versus the average stock. And you'll find that continental Europe looks attractive. But then what's interesting is China, South Asia, Korea, and Taiwan, the black dots on this page representing the data as of the end of May, actually have good spreads versus the long-term average in terms of standard deviations, and EMEA in general, Europe, Middle East, and Africa. So our view is US, on the other hand, is below its long-term average. So the returns possible for first of all, value stocks in these parts of the world look very good. But more importantly, what we also found is that when these spreads are wide, it tends to be good overall for the regions itself in terms of their own performance. If we turn to the next slide. So again, we have a few charts just showing how globally today the quintiles by price to book are being priced. And what it does over here is just looking at price to book on a monthly basis, going back to December of 2009, roughly of 30 years, and seeing where we are today. And what we find is that the only part of the universe of stocks that looks very cheap to us is the cheapest quintile, which is below the line. So everything else is fairly priced to us, whereas value in general across the world is mispriced. And if we turn to the next slide, you'll see for the US market, which even value in the US market is pretty close to this long-term fitted line. So we don't see huge opportunity in value in the US, but it does exist to some extent versus the other quintiles of price to book. Following, go to the next slide, you'll see it for Europe, some attractiveness to the cheapest quintile, but not by a huge amount. Following slide, please. Japan looks actually quite interesting. The spreads are wider here. And then go on to the next slide. EM, on the other hand, actually, we think that not just the cheapest quintile, but perhaps even a couple of other quintiles right up to the median, actually looks very interesting in terms of a wide valuation opportunity set. And we're seeing it in every single sector. And moving on to the next slide. It just shows you the geographic distribution, the cheapest quintile of price to book. The US market, as you'll see, today has about a 5% representation, the cheapest quintile of valuations. On the other hand, emerging markets, which tend to be the gray bar here, actually has the biggest of emerging markets. Asia has the biggest opportunity set, despite being, as you can tell, in 2009, only being 10%. Today, on the other hand, it's almost about 40% of the cheapest quintile. So emerging markets to us are where the biggest opportunity is in terms of the cheapest quintile of valuation. And if you turn to the next slide, you'll see the same thing again, going back in the most expensive quintile of valuation. What's interesting to us is US stocks represent almost 40%. EM is a much smaller portion compared to US there. So that's all I have to say. We think from a geopolitical standpoint, from the standpoint of the fiscal and monetary situation where emerging markets are positioned today, the degree of internal stability of these countries from an internal political standpoint, and most importantly, from a valuation standpoint, emerging markets are positioned, in our view, for a decade of superior returns versus pretty much any other part of the world. Thank you.
Thank you. Thank you very, very much, Rama. We really appreciate your thoughts and the work that you're doing on behalf of our clients. Thank you. We'll now turn things over to Chris Leeds. Our team approved Chris's fund at JO Hambro back in 2009, and it is a cornerstone in almost every one of our client portfolios at this point. So Chris, thank you very, very much for all the work you and your team has done on behalf of all of our clients through the years. Thanks for taking the time to be with us today, and the floor is yours, my friend.
Oh, thank you very much. It's been a great pleasure working with you and your clients since 2009. Just checking you can hear me, just checking you can see me. Terrific, thank you very much. I'd love to do just a quick poll, if that's allowed, ask a few questions, make this interactive. So here's the first question for everyone in the audience, if you're still with us. A very simple poll question, give you 30 seconds to answer. From the following list, which currency has been the strongest year to date? As at last night's close, this is. The US dollar, has that been the strongest? The Russian ruble, has that been the strongest currency? Or the Brazilian real? Which of those three? Please vote, please join in, please make it interactive. Which has been the strongest currency year to date? So that's close of markets end of December until close of markets last night. And the reason I asked for currencies, I'll just talk a bit while you put the answers in, is actually a lot of people misunderstand the following. When you decide to invest in international equities, your first risk isn't actually equity risk. Your first risk actually is currency risk. Very few people really understand that. And so you've got to be quite confident in your currency assessment when you decide to invest internationally, which is why I asked the question. So the answers are fascinating, folks. I'll just put my glasses on so I can make sure I'm correct. 48% of you said, yeah, duh, of course the US dollar's been the strongest year to date, but actually it's the weakest of those three, folks. Actually, the US dollar has been weaker than the Russian ruble year to date. And actually the US dollar has been weaker than the Brazilian real year to date. So just an important reminder of understanding there's more going on around the world than a lot of people realize. And we have a quote, there's usually a bull market somewhere in the world, and that's what we try and do. What I didn't tell you is of that list, the Russian ruble is the strongest currency year to date of any currency on the planet. Now, would I have forecasted that? Absolutely no way. Would anybody have forecasted on the invasion of the Ukraine that when the Russian ruble tanked, would anyone have forecasted that it would end up being the strongest currency in the world? I think the answer is not many. Point being, don't try and forecast, folks. Humans can't forecast. Don't invest in an investment process that's over-reliant on forecasts. Read a book called Super Forecasting. Please read a book called Super Forecasting. And what that'll teach you, and it'll show you categorically, humans can't forecast consistently. But what humans can do is assess various different scenarios and then probability weight those scenarios. That's what we do. I'll talk about that later. Love to do the second poll if we could, please. And thank you all for voting. Really appreciate that. So second poll is about country performance of the equity market. So we've done currencies. Now we're doing from the following list, which MSCI country equity index has been the best performer year to date, as at the close last night in US dollar terms. Is it China, the best performing market year to date in US dollar terms? Is it the USA as the best performing equity market in US dollar terms? Or is it Australia as the best performing equity market in US dollar terms? And part of the reason I'm asking you this is point number one, I said before, the first decision when you're going overseas, the biggest risk is actually currency risk. And then the second decision, obviously, the second risk is where do you want to take equity market risk? And very, very important because equity markets are very, very similar to real estate, folks. And you all know in real estate investing, if you buy a really good house in a rapidly deteriorating neighborhood, you're going to lose money. Yeah, it doesn't matter how good your house is if that neighborhood is deteriorating really, really rapidly. And that's our process in the stock market for our clients. It's one of the things that our clients really like. It's very intuitive. We say we're only going to pick a stock in a really good neighborhood. Yeah, and so beware good houses in bad neighborhoods is a key part. So I'd love to see if we've got the results in yet of which equity market people think has been the best performing. I can't see the results yet, Glenn.
So Chris, it looks like Australia came in first with 55%, followed by China at 32% and the US at 14%.
Okay, so that's a much better job by the audience. Well done, the audience. You've kind of figured out that I'm going to ask you controversial questions, probably. And Australia is second, folks. China is the best performing equity market year to date. Of that list I gave you, China is one of the best performing equity markets year to date. But that's not people's perception, is it? People's perception is, oh, China's probably uninvestable. And I'm reminded of a really good quantum physics book, if you haven't read it, a really good quantum physics book by Carlo Rovelli, Reality is Not What It Seems. Reality is not what it seems. And that's why investing is so difficult, folks. Yeah. So who would have thought on January 1, China was going to be the best performing market of those three lists? So point number one I've given you is don't forecast, think in scenarios and probabilities. Point number two is don't take everything that you read in the newspaper as face value, because reality is not what it seems. You've got to dig a bit deeper to find out what's going on. And to the surprise of many, MSCI China is the best performing on that list. Australia, of course, is a very good performing market because it's full of commodities. And the clear lesson that we see at the moment is you want to invest in commodity countries that are exporting. So things like Brazil, things like Australia, things like Canada, things like Indonesia look really good in the international world. And the commodity importing markets, like say Japan or Europe, yeah, are short-term struggling. And then the third poll question. So Europe versus the USA since the Ukraine invasion. Since the bottom of the Ukraine invasion equity market sell-off, which was early March, so since the early March bottom, has the MSCI European Index outperformed or underperformed MSCI US Index in US dollars? Top button if you think Europe has outperformed the US, bottom one if you think Europe has underperformed. And this is really getting back to that combination of currencies, of equities, of neighborhoods. And what a lot of people forget, which gets me into the third bullet point, is when you're discussing a region like, say, Europe or America, you really want to dig down and have a look at the sector positioning, because that will give you a really good clue, because different regions are dominated by different sectors. And so for some regions might be dominated like tech, and some regions might be dominated by banks or automobile companies. So the sector effect also is very, very important, as well as the country effect, as well as the currency effect. So I'd love to see the results. Now, if I'd shown you this slide first, I don't think I'd have got these results. Yeah, so I think most of you have figured out, okay, Chris is going to show me something that is counterintuitive. So well done the audience for figuring out that it was counterintuitive. But I put this up quite seriously because many, many, many of our American clients have told us Europe's uninvestable. Many of them have told us Europe's uninvestable. And I have to go back to them and say, well, reality's not what it seems, folks. Actually, it might be NASDAQ that's uninvestable. Yeah? I don't know the answer to that question, but actually Europe is currently outperforming the USA. Wow, not many people know that Europe is currently outperforming the USA since the market bottom of the Ukraine crisis. So well done for all of those that working that out. So I bring that all to the process. Now you can see why we do, first part of what we do is old-fashioned stock selection. That's like buying a good house. The second thing is, what's the neighborhood? You don't want to buy a good house in a bad neighborhood. So we think about the country as a neighborhood. We think about the sector as a neighborhood. And then the fourth dimension is everything's always changing, folks. You can't be backward looking. You can't be dogmatic. You got to keep changing. So how do we do that? Next slide, please. In the next just 5 minutes, I'm going to be really respectful of your time. So my first objective is to finish on time. My second objective is to leave you some money-making ideas. Yeah, my job is to make my clients money. So leave you some money-making ideas. This is how we decide the neighborhoods. You might find it quite useful. And then we recognize they change. We've ranked the neighborhoods by sector at the top, by regions at the bottom. The top two at the top left are the commodity complex. And we score everything by fundamentals first. Good is green, orange is average, red is bad. By valuation second, orange is average, green is good, red is bad. And then by price trend third. Remember, you lose money on stocks that are in downtrends. You can only make money on stocks that are in uptrends. For us, rule number one, only buy stocks in uptrends. Rule number two, never ever forget rule number one. That's the biggest money-making lesson I can give you as a gift. I'm trying here to help you make money. So we sum those three scores: great fundamentals, great valuation, and the trend is good. And sum those three scores, the green lights on the total score, they're the good neighborhoods. That's where you want to go looking. That's where you want to go fishing. And you can see the commodity complex is green. But right now we worry about a global recession. So we'll wait as markets worry about the global recession, and we'll look to buy the next dip in commodity-related stocks. That's the forward-looking part of what we do. You can clearly see the interest rate cyclical areas are all red lights. So we don't like financials, we don't like consumer discretionary, don't like banks, don't like car companies, keep selling them. The green lights in the CapEx cyclicals of industrials and technology, we do still like those areas, and we see a CapEx boom coming globally as the world splits into three parts. So again, we will be buyers of the dips from here in CapEx related stocks in industrials or technology. I'll talk about it later. The next set of sectors are all the defensive growth of healthcare and consumer staples and the defensive bond proxies of comms services utilities. And you can see that we only like healthcare in that neighborhood. The process does not like consumer staples, comm services, utilities. They're red lights, but the process really likes healthcare. So we continue to buy the dip in those three areas. Healthcare is the best low beta sector. CapEx plays for future growth. The only way you can fix supply chains, folks, is more CapEx. So buy the dips in tech industrials and buy the dips in energy materials. By region, North America is still just a green light, but probably heading to orange lights going forward. Europe and Japan are probably as bad as they get, and emerging China is beginning to recover. So some of these scores we think will change in the second half of the year. We think the European, Japan, emerging Asia, and China scores, we think they'll follow Brazil. And you can see Brazil and emerging Latin America at the very bottom, already a green light. And what Brazil has, as I said, what Canada has, what Australia has, what Indonesia has, we really think it's a great neighborhood to buy stocks in the commodity exporting countries. And the red lights are nearly all commodity importing. So in the short term, we're a bit cautious on Europe, Japan, but I think they will improve. And the next neighborhood, following on from what the earlier speaker was saying, the next neighborhood on our process to turn green will be emerging Asia. That will be. So we have a great process that tells us how the world looks today. This tells you how the world looks today. Then we've got to think about how it's going to change. And that's what I've tried to map out for you. So in just a few very quick seconds, the next slide, please, as I've got only a few minutes left. Think in scenarios. As I said, don't make heroic forecasts. Our current scenario analysis is 50-50, 50% bullish, 50% bearish. You can see the green light down, the red light up. We've got less bullish than we used to be. Scenario one, we think is only a 30% probability from here, and that's equity markets rallying with some of the old growth leaders. And within that, it's semiconductors. By far and away, semiconductors are our favorite high beta offensive sector. So when you want to get bullish again, whenever it is, buy semiconductors. Scenario two is what we call markets rallying with the new value cyclical leadership. Previous speaker talking about the great opportunity that is there. We absolutely agree, the great opportunity in the value side, but not financial stocks, folks, not consumer stocks, folks. Our preference is these commodity related stocks, particularly the ones in energy transition. Think about energy transition. Think about the next 10 years. It's really good for copper. It's really good for lithium. It's really good for zinc. Yeah, it's really good for semiconductors. It's not so good for oil. It's not so good for other things. So look to buy the dips in what we call future-facing commodities as your cyclical value plays. And at the moment, have a lot of defense. Scenario three is bear market. We're in a bear market. You want a lot of defense because of the policy mistake risk. We've got fiscal, monetary, geopolitical policy mistake risks. They're all rising. And within that defense, as I showed you earlier, healthcare is by far and away the best low beta defensive place to go buy the dips and stocks. And at the bottom, don't forget there are medium-term reasons to be bullish. Supply chains always fix themselves, folks. Supply chains always fix themselves. It's just a matter of time. Malthus was wrong. If you don't know who Malthus was, I haven't got time to tell you, but Google him. You'll find it very interesting. Never, ever bet against human ingenuity. Never bet against human ingenuity and the profit motive to fix problems. So there are some very good reasons to be bullish. There are obviously lots of reasons to be bearish that we all know about. Next slide in 1 minute, please, and then I'll try and hand back for Q&A. But the point being, managing your money on international versus US or EM versus DM, actually quite old-fashioned way of managing money. Managing money on sector rotation, actually quite an old-fashioned way of doing it, because you've got these things called global mega themes, global mega trends. So the title says the neighborhoods aren't just the sector, they aren't just the country. So I showed you our top-down scorecard with the red and green lights. We also think not just in geography, not just in sector, we also think in these global themes. And deglobalization, digitization, decarbonization, they're all accelerating since COVID, since Ukraine, and they affect every investment in every geography. They affect every investment in every sector. And then the top one is the biggest driver of returns year to date. It's got nothing to do with geography. It's got nothing to do with currency. It's got nothing to do with sectors. The biggest driver of winners and losers year to date is what's called duration. Yep. Long duration growth stocks have massively underperformed, just like long duration bonds have massively underperformed in every sector, in every geography. And short duration value stocks and short duration fixed income have outperformed in every geography, in every sector. And that probably peaks as inflations and interest rates peak some point later in the year. So with that, with 1 minute to go, I'll hand it back to Glen.
Well, thanks so much, Chris. I certainly appreciate all of your insight on things as always. I know that we've had a couple questions that I think one of our analysts has queued up, and I'm going to monitor the Q&A section over here. So folks that are watching at home, if you want to ask a question, please go ahead and type it in, and we'll get your questions answered here.
Chris, a question for you as our clients and audience continue to put their questions in the Q&A. Could you talk about a few of your transformational stocks that you've owned, where since we've had an investment in your strategy for 13 years, a few transformational stocks that have made our clients a lot of money, and your clients as well?
Oh, great question. Yes, I'd love to talk about that, Ben. Thank you very much. We think that transformations is often where you make the big money, and I'm talking 5, 10 baggers. And we go looking for transformations because the market doesn't understand them so well. That's why you make so much money. And if it's a positive transformation, you get positive future earnings growth at a much higher PE. So we bought into the IPO of a Danish dirty fossil fuel electric generating company called Dong Energy. And it was a dreadful company, but they were IPOing to raise money for these new things called wind farms. This is years ago. And to transform themselves away from low margin, dirty fossil fuel electric generator, to transform themselves into that today they are the world's #1 wind farm company on the planet. And today they're called Ørsted, O-R-S-T-E-D. Have a look at it, folks. That transformation, we made 4 times our money for our clients. So if a client invested 100, it's worth 400 today. But the interesting thing is, once that 5-year transformation is finished, share price has been going sideways, which proves the point. Often you make the most money on the transformations. I describe it to, in a multi-faith world, I describe it to my Christian clients, and that it's like looking for St. Paul on the road to Damascus. And I would use a different analogy for a different faith, obviously, but there's a huge amount of money in investing in positive transformations. Another one was a truly awful company called Delphi Automotive in America, went spectacularly bankrupt 2008, 2009. Private equity bought them out of bankruptcy and parachuted in a new management team who we know very well because they used to manage a company called Fisher, and they sold themselves to Thermo to become Thermo Fisher. That's such a great company, we still own it, okay? But this management team turned around Delphi Automotive into a company that's called Aptiv, A-P-T-I-V. Have a look at it, folks. It's the #1 EV electric safety wiring software company on the planet. What a transformation. And they've still got a huge growth ahead of them, obviously, as they are now the leaders in that space. So there's 2 very good examples, Ben, of looking for the transformations. Not every transformation works, but here's the interesting mathematics behind it. Not every transformation works, you lose a bit of money, but the few transformations that do work, you make 3 to 5 times your money. So it's worth it at the portfolio level.
Thank you, Chris. A quick question for you, and then we've got a question for Rama as well. Chris, on your last slide, one of our clients is asking if WFA stands for work from anywhere.
It does stand for work from anywhere. Thank you. A big change from work from home to work from anywhere.
Got it. Thank you. Rama, one of our clients is asking, as you look at the emerging markets in general, what are, or are there any specific things that you can point to the Russian invasion of Ukraine and then say, okay, because of that, here is where we're seeing additional activity because people can't get those same things from the area that they used to get them? Are you seeing additional activity in any of the other markets as a direct result of the invasion, I think is what's being asked here?
Yeah, I think there are 2 aspects to, I guess, the Russian invasion of Ukraine. One, of course, is the impact on energy markets. So very clearly, you have both an impact from the standpoint of not able to invest in some of those energy companies that are now restricted because of sanctions, or because the market shut down in Russia as well, such as companies that produced oil and natural gas from the Lukoils to the Gazproms of the world. So clearly that has an impact in terms of what else you could access the energy space. The other area where we're seeing potentially an opportunity, and this is again goes back to the point that Chris made earlier, was in countries like Brazil, where given what's going on with the shutdown of exports of wheat, for example, from Ukraine, countries that have the wherewithal to produce more in terms of food, or for that matter, energy, are going to be in a much better position for the foreseeable future. And you've seen some actions that have actually prevented what was in the markets in terms of supply from actually continuing to be the case. So India, for example, has restricted wheat exports now, rice exports as well, I think. So to that extent, countries like Brazil would actually benefit from what's going on in Russia.
Thank you. We actually have another question for you, Rama. It's amazing. We're 66 minutes into the call and we haven't talked about COVID. And so as you look at the available countries that you have to invest in your investable universe, how does the pandemic and the current status of some of the countries factor into your decision making and your thought process?
Yeah, and I think all of us clearly have experienced COVID at its worst. I would say in the last couple of years, there have been periods where we did go some really bad spells, but in my view, it's nothing compared to some of the bad spells countries like India had gone through during COVID, or for that matter, Brazil, and then more recently, as we see from all the headlines, in the lockdowns in China. Interestingly, we would say that most of the emerging market countries dealt with COVID far better than most countries in the Western world did, meaning that yes, they did go through a quick period of pain, especially a country like India or Brazil, for example, did have far more fatalities, at least especially in India. Activity in general has come back very strongly in most parts. And supply chains within India, for example, have gotten a lot better in terms of catering to local demand, at least, and even export demand. So they've dealt with it far better. And that's simply because they are used to healthcare crises in the past or other kinds of crises in the past. So for them, COVID is just one more thing over time in terms of issues to deal with. And they've taken it very well in the stride. China is the one country that perhaps has a little more, maybe it was policy mistakes that drove them to the zero COVID policy. But India, clearly the reason why so many people died is that the healthcare system just wasn't there, not even close to what the issues were in New York City. I mean, just overwhelmed the healthcare system massively there, and that's why so many people died. China, on the other hand, realized that if the same kind of COVID impact was going to be held in China, they would also have the same kind of death rates. So they had to lock down a lot of the cities just to prevent the hospitals from being overwhelmed. So it might be a policy mistake to say that you want to have zero COVID, but politically, I don't think the leadership they had any choice but to do what they've done and continue to do, which is lockdowns dramatically reduce the cases and then have very selective lockdowns and extensive testing, which is what is going on right now. So our belief is, in the early stages, a lot of these countries in North Asia in particular dealt with COVID really well. They have been a little worse in terms of vaccines and the use of them or therapeutic treatments for COVID. But, given that, today the actual side effects from COVID tend to be pretty low in terms of at least people who don't experience long COVID. The issue is people just get sick and move on with life. And so we don't see a lot of impact from COVID looking out 1 year from today in these countries. China is the one country that's impacted today with supply chain issues. But even there, over time, we see that issue being diminished as they get more testing in place, like they have in Shenzhen, for example, that anybody can go and get a test right away, and they've had that in place. And that's one of the reasons why the COVID levels in Shenzhen are far better than even in Shanghai.
Thank you very much, Rama. Chris, I would throw the same question to you. Anything that your investors ought to know about how COVID is impacting your process?
No, I would agree with pretty much everything that's been said. I would add, it's another example of you should never get too bearish. You should never bet against human ingenuity. Just think about how extraordinary the scientists found, tested, and rolled out a vaccine, for example. So we've got a great ability to, deal with crises. Crises come and go. We deal with them. Yes, at the moment, it's the correct time to be defensive and slightly bearish, but don't get too defensive, folks. Don't get too bearish. Don't throw in the towel. Look for the next opportunities. Just like COVID, we've broadly dealt with some of today's issues. We've broadly dealt with. It's a non-issue here in Europe, where I currently am. Absolutely, it's a non-issue. If it comes back, it's dealable now for multiple reasons. But that does tip me into one bullet point, which I wanted to make earlier, but ran out of time. When you're looking at investing in Europe or Japan, don't fall for the trap of buying what we call Euro trash. Don't fall for the trap of buying what we call Japanese zombies. Yeah, if you're going to take the risk of looking for stocks in Europe or Japan, look for the global champions. And people often forget it's not just America that has global champions. Europe's got two global champions, for example, like L'Oreal in cosmetics and ASML, a near monopoly in semiconductor capex. Over time, you've always been paid in the past to, whenever there's a Euro crisis or a COVID crisis is the point, Glen, or a Japan crisis or an EM crisis, you've always been paid to buy the global champion companies that happen to be in that neighborhood. Japan's got two things called Sony and Keyence. You can't buy anything like Sony on the US stock market. So that's good diversification. You can't buy anything like Keyence on the US stock market. Keyence has a global monopoly on a certain part of machine vision for factory automation. And you can't buy that in the US. So one of our number one messages to leave you with is don't get too bearish. Just play defensive temporarily. Number two, use this sell-off to look for the great companies in Europe, the great companies in Japan, the great companies in EM. And it's tied into your question because that's what we were doing during the COVID crisis, Glen. And we've got some wonderful opportunities in the COVID crisis to buy the dips in these global champions. And I think that's what the best advice I can give to the audience, buy the dip in great companies during this crisis.
Thank you very much, Chris. It looks like we've gone through all the questions and we're going to wrap things up here. So thank you everyone for joining us today. We really appreciate your time and the thoughtful questions. If you have other questions that you didn't get a chance to ask, please feel free to reach out to your team members at Arnerich Massena. We'll be happy to answer them as best we can. I'd like to remind everyone that we will be sending out a survey in the next few days, so please take a few minutes to provide us with your thoughts and feedback. We'd certainly appreciate it. We'll also make a recording of the webinar available, so please feel free to share that with anyone that you think will find it of value. Thank you so very, very much, Ben and Melissa, for starting us off today. Thank you, Rama and Chris, for all of the data that you folks provided and for all the hard work you've done on behalf of our clients. We really appreciate the two of you. We hope that everybody has enjoyed hearing from our team today. We will keep you informed about upcoming events and webinars, and we look forward to seeing you all there. Thank you so very much, and have a great rest of your day.